Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, September the 14th. I'm going to take just a brief minute to discuss what markets did last week, as it was a down week in equity markets, with the S&P 500 finishing the week down 1.29%. And your more economically sensitive names and your more cyclically sensitive names in your mid cap and your small cap indexes were down much worse, with the mid caps down 3.56% on the week, and the small caps, as measured by the S&P 600, were down 4.7% on the week. And as we were heading into this week, all eyes, of course, were on inflation, what the Fed's going to do, and is inflation actually picking up? Well, inflation did pick up for the month of August, and that was to be anticipated, as you saw CPI come in at 3.7. That's up from 3.1% in July. And the leading indicator for that was really energy prices going up. And why you saw the stock market not really react negatively yesterday, as inflation was a little hotter than expected, was if you peeled back the layers there and looked at the inflation report itself, some sticky areas that we've been wanting to see come down, like rents and housing, are starting to come down. And so that's why you saw the market react the way it did yesterday. It wasn't so very negative. So the other thing too is core CPI, which is what the Fed is looking at, fell from 4.7 to 4.3% in the month of August. So continuing its climb down, trying to get below that 4% threshold. So investors have been wondering and monitoring what the Fed is going to do based on inflation and the Fed's target to get to 2%. And I want to take a brief minute on the fact that we actually think at River Place that the Fed's going to get all the way back down to 2%, and what caused it to get to 2% in the first place. Well, 2% inflation that we were seeing for starting in the 90s through the 2010s we were a big benefactor of globalization. We were producing goods in foreign countries at very low costs and importing those, and that really helped cause inflation to come down over those years and not be at that historical around 3% target. So as we're onshoring jobs, as there's conflicts, remember there weren't that many conflicts in the world. There's a conflict going on in Europe right now with Russia and Ukraine. There's also the threat of China invading Taiwan. They have made that very clear that they want to do that. So countries across the globe in Europe and the United States are spending more money on defense. This is a drag on productivity and inflationary in its nature. The U.S. population, as well as the global population, is getting older. This is also a drag on productivity and inflationary, as social costs and things and medical costs go up to provide the services for an aging population. So all of these factors are really going to be tough to get the Fed down as we continue to onshore. And you're seeing wages increase in this country, and you're seeing labor strikes, and you're starting to see wages increase. But that's going to cause the cost of goods to be more expensive to produce here in the United States than if we were actually doing it somewhere else. So we don't believe that the Fed is actually going to continue to raise interest rates until we get to that 2% target, because if they were to continue raising rates much higher, the economy that we would get would not be what we would want, and it would be a very, very sluggish and recessionary and have a lot of damage to our economy. So what the Fed is doing is probably going to hold rates here in restrictive territory for longer. They may raise again in November. They may not. We don't anticipate them raising in September when they meet. But what we have to adjust to as investors is, where do we see the opportunities moving forward, and is the economy doing as well as we anticipate it to do? We got the first read from the Atlanta Fed for third quarter GDP at 4.9%. We got retail sales with estimates up 0.1%. Retail sales were up 0.6%, showing that the consumer still remains in a really great position. And according to Jamie Dimon this week, when he was out speaking, he's the CEO of JP Morgan, the largest bank in the United States. The consumer balance sheet right now is in a better position than it was pre-pandemic going into COVID. So yes, rates are higher. Yes, credit card debt's at an all-time high. Yes, student loans are coming back on board. But this is kind of what a soft landing looks like. There's slow places and there's areas of pain and some that are benefiting right now, some that are not. This is what a soft landing looks like. So if you have questions about how to position your portfolio, and the other thing to mention here with the inflationary rates is data here is that we expect the longer end bonds to be to move higher than they are today. When we come to the realization, the market comes to the realization that the 2% target may just be a really tough bogey to hit, and that we may just need to adjust back to the standard or the more traditional 3% inflationary rate. So if you have questions again about how to navigate your portfolio as we're going through these challenging times, feel free to give us a call. That's what we're here for. We're happy to walk you through it. And as always, give us a call at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. Have a wonderful rest of your week, everyone. Thanks so much.